So, the loanable funds market can be described as the available supply and demand for money. So, the supply of money is going to be provided by those who are doing the lending, and the demand is going to be done by those who are doing the borrowing. So, traditionally, we see banks lending and consumers borrowing. And the Federal Reserve is going to provide us with our primary source for loanable funds, and they will determine the amount of supply of money in the system because they are able to alter it with the discount rate, with reserve requirements, and with open market operations. So one thing we notice is that I'm just trying to put quantity of money down here on that. Quantity of money is on the x-axis here. So when the Fed increases the supply of loanable funds or money, then we see that interest rates fall. When they decrease the supply of loanable funds or money, we see that interest rates rise. So therefore, when the Fed goes in and buys bonds, which add money to the system and allow for more lending to occur, more depositing and lending and depositing and lending, etc., expanding the money supply through the system of fractional reserve banking, contingent on the reserve requirement, which gives us our money multiplier, we see that increases in the supply of money will decrease interest rates. When interest rates are lower, this allows consumers to purchase more goods and services. Think about your home, a mortgage payment you might have. If interest rates are lower on the value of your mortgage, then that means, ceteris paribus, that you have more money to spend on all other goods and services because you're paying less interest every month. Now, if interest rates were to increase, then, and most mortgages are fixed, but if it was a floating mortgage or an adjustable rate mortgage, you would see the interest increase on your monthly mortgage payment every month, and that increase in interest would actually mean that you would have less money, ceteris paribus, to spend on goods and services. So when the Fed increases the supply of loanable funds by buying bonds and injecting money into the system, which is then deposited and lent and deposited and lent, interest rates fall, and when interest rates fall, consumers will buy more goods and services. This should shift aggregate demand through consumption, since aggregate demand is the combination of consumption, investment, government expenditures, and net exports. And if we change any of those variables autonomously, we will see a shifting of the aggregate demand curve. The idea with expansionary monetary policy is that say our long-run aggregate supply curve is this purple line here, and we are short. So this area here representing our GDP gap, and therefore we have cyclical unemployment. We have goods and services not being produced with available land, labor, capital, and technology that could be produced if our aggregate demand curve shifted outward. So when the supply of loanable funds increases, dropping interest rates, it increases consumption, a component of aggregate demand, and hopefully reduces unemployment, increases real GDP, and brings us to our long-run intersects with our long-run aggregate supply, where any other increases in aggregate demand would really just increase the general price level, and decreases short of long-run aggregate supply or full employment real GDP means that we have unemployment. So in conclusion, this discussion went through looking at what the money multiplier is and how this concept is affected by or affects the fractional reserve banking system. So we needed to learn a little bit about, well, what is the money multiplier? What's the formula for this concept? And what are reserves? What are required reserves? How are required reserves held in a bank when new deposits are made? And when a new deposit is made into a bank based on the amount of required reserves that are to be held as a deposit with the Fed, through the multiplier, how does this influence the size of the money supply? What is the change in money supply? And then we kind of looked at the Federal Reserve and their 3 policy tools for influencing expansionary or contractionary monetary policy. And we went through an example of expansionary monetary policy and the transmission mechanism through which aggregate demand increases to hopefully bring us to an equilibrium production of full employment, real GDP. So if you have any questions on this material, please don't hesitate to contact me. Also, I suggest going through an example of contractionary monetary policy on your own. And please ensure that you understand what happens when new deposits are made as they affect the asset and liability side of a bank's balance sheet, and how the bank responds to this deposit. Again, please let me know if you have questions, and I hope everyone has a wonderful week. Thanks for listening.